Hello everyone and welcome to this video. So in this video we're going to talk about how to invest or manage your money in your 30s. So we have already covered a video about your 20s. So if this relates to you more, please watch this video. Okay. So what are the assumptions that go into this video or this discussion? The assumptions are that your career graph has already started in your 20s. So you started working in your 20s and are doing quite okay, right, in terms as compared to your 20s. Then you have student debt or consumer debt, that is your priority to pay. Student debt will be the student loans that you took. Consumer debt might be the car loan that you have because you bought a car. You have some savings, some sort of savings, right? Or you have a plan for doing your savings, at least a plan. Then you're either bought a real estate recently, or the more important part that we're going to discuss, you're planning to buy real estate. Most people in North America, especially in Canada, buy real estate in their 30s. So these are the common goals that you might have in your 30s. Not everyone would have these goals, but it's important to frame discussion around some common goals so that these could be the guidelines for you. So the first thing that you should think about is having an emergency fund. So emergency funds are for emergencies. So let's say your car breakdown, the insurance is not covering it, you have some health emergency, you need to travel to visit your family, some kind of emergency. So you need some funds to deal with that. Then you might want to buy a house. Most people do it in their 30s. So you might be accumulating down payment for your house, or you're planning to start accumulating down payment. Then you might have a child, right? So most people have kids in the 30s now instead of 20s. So that also is an important goal to start thinking about. And finally, retirement goal, which is a common goal between 20s and 30s. So emergency fund. So what are emergency funds? These are for absolute emergencies. You need to lend money to family to take care of their health. Maybe it's your parents that need money, right? Car breaks down, something happens to your house, some kind of liability, right? So you need some funds to deal with it. So financial planners recommend that you need to have 3 to 6 months of living expenses to deal with your emergencies. You also might want to think about supplementing emergency funds with insurance. So let's say having a car insurance, having a disability insurance, all kind of insurances are supplementary. They supplement or complement, right, emergency funds. So this is a good pyramid to think about emergency funds. So the first thing that you will use for emergencies is your savings account. Savings account is an interest bearing account. So it's not the checking account that you have with bank that doesn't generate any interest. Savings account in banks or in non-bank entities have some kind of interest in them. So we want to keep some part of emergency funds in our savings account. That is going to be our first go. The second would be money market ETFs. Money market ETFs are kind of savings account. So they have liquid money, so you can access money very easily. Same way you can do it in savings account, and they're also very low risk because they mostly invest in commercial papers or short-term debt, so that is lower risk. But they have a better interest rate than savings account most of the times. So it's important to allocate or divide your money between savings and money market accounts. Then you can augment these two by having a line of credit, right? Line of credit is like a loan. So you get access to certain credit, line of credit based on your credit worthiness, right? And if you use money from that line of credit, then you have to pay. Then credit cards are the last thing you should rely on for your emergency funds. So what is a savings account? You can open it with a bank online, or you can go to a physical bank and open it. It generates compound interest. So whatever money you keep in savings account, it will start generating interest on it. And right? Whatever interest all accumulates in the savings account, you get interest on that too. So interest on interest, that is compound interest, happens in a savings account. Generally they have lower interest rate as compared to money market funds. My strategy is to keep 33% of the emergency funds that I need in a savings account. We are going to see a calculator to do, like, to see how much you need and whatnot. 33% is a good number to accumulate in a savings account. So example of a good savings account. So there are a lot of fintech companies nowadays that are coming up. So Neo Financials is one of them. It's Calgary based. So they have better interest rates on their savings account. So if you see product, so you have Neo Money, I guess, and let's see the interest rate on that. So it's 2.25% interest right now they're providing on their savings account. Okay, you might be able to get better interest rates than this, but this is a beginning. Okay, then what are money market funds? Money market ETFs you can buy on the stock market, so you need to have a brokerage account to do that. So these funds invest in short-term interest-bearing instruments. Now, good part about money market funds is they can be part of registered accounts, like tax-free savings account. You can add them in registered retirement savings plan, RESPs or FHSA. The important aspect of them or feature of them is they have a higher interest rate than savings account. So the interest rate that you get on a money market ETF is better than a savings account. My strategy is to keep 50% of emergency funds in a money market fund. Okay, so example of a money market fund will be something like this. So this is an money market fund. So cash.to, right? That's the symbol for that. You can buy it through your brokerage account. It gives an interest yield of 5.39%. So the rate of interest that it is providing is 5.39%, and the risk rating is low because it invests in mostly Canadian bank deposit, high interest deposits. Okay, so something like this you can add as a part of your emergency fund. Then you can also have lines of credit. So lines of credit is where you borrow money from a financial institution. There are two types of lines of credits: secured, which is against something. So maybe it is against your home equity, which is the most common one. So you have a house, you have a mortgage. The difference between the house value and the mortgage value, if it is reasonable, then you can get a line of credit against it. Those kinds of lines of credit will have lower interest rate because they are secured by something. Then you also can get an unsecured line of credit where it is not secured by anything and the interest rate is higher. They have lower interest rates than credit card. That makes them more attractive than credit cards, especially for emergencies. My strategy is to use line of credit as the last resource, so it supplements my emergency funds. Credit cards, not a good way to use for emergencies because they have very high interest rates, and if you're removing cash from them, they have cash advance fees. So in all, they're very expensive. So this is an interesting Google sheet that shows the working of emergency funds. I'll be sharing it so you can see how it works. So I have it opened. So let's see, your monthly expenses are $4,200. So if you just enter the monthly expenses and how much time you want to accumulate that. So let's say you want to accumulate the emergency fund in 24, so let's say 6 months of emergency fund is required. So $4,200 is your monthly expenses. Financial planners recommend 3 to 6 months. So we said 6 months of living expense we need. So 25,200 you want to accumulate. So strategy, like we discussed, 33% you'll accumulate, or I would accumulate, in savings account, 50% in money market funds, and then 17% in line of credit. So this is now 5.25%, the interest rate. So this will show you calculation. If you just change, like let's say I want to accumulate it in 24 months, all these funds I want to accumulate it in 24 months. So what I'll do, so in 24 months, if I have to accumulate 33% of 2500, that is $8,300, I would need to start investing $334 every month in towards my emergency funds. If I want to accumulate it like 50% of this in money market funds, that is 12,600, then I have to start accumulating $500, $492 every month to do that. This is the first thing you should do when you're making a financial plan. Emergency funds are very important because any emergency can completely ruin your financial plan. So once that's done, then you can think about other goals. So let's say your goal is to have down payment for your house. So down payment, there are 3 questions that I have divided into. So first thing, how much down payment should you accumulate? The answer is you should try to target 20%, because when you have more than 20% down payment on your house, then you do not have to pay for CMHC insurance fees. CMHC insurance fees can be very costly because they are as a percentage of the house value that you're taking. That can be quite expensive. So if you try to accumulate 20% or more than 20% of down payment on your house, then you save on CMHC insurance fees. So that will be thousands of dollars that you're saving. Then where should you accumulate? Which account should you use to accumulate down payment? The answer is the best one is First Housing Savings Account. This is the new account that was launched. They have started opening it in 2023. It's a very fabulous account. It has $8,000 yearly limit. So first of all, you should max that out. Then use things like RRSPs and then TFSAs to augment it. Why it is so amazing, this account? It is amazing because it has tax-free growth. So whatever money it grows to, whatever interest you generate or whatever income you generate, it is completely tax-free. And once when you invest in this account, you also get a tax deduction. So it lowers your taxes. So most likely, if you are putting it in this account, you might get a tax refund. Now, where do you invest? So you should try to add low risk investments to accumulate your down payment money, because you need to have that security, right, for down payment. You don't want to invest in stock markets because they're too volatile. So you can use money market ETFs like Cash.to, 5.25% interest. They're low risk, they're highly liquid, and they provide decent interest. So again, a Google sheet to make a point. So this is this down payment Google sheet. So let's say you're just starting, you want to buy a 1-bedroom apartment. So Calgary, it's somewhere around 250,000, 260,000. So we said that down payment percentage should be at least 20%. So let's target 21% to be safe. So down payment will be 52,500. You want to accumulate it in 3 years. The interest rate right now on this high interest saving account or Cash.to, like money market ETF, is 5.39%. So we keyed that in. You have $500 to start. This will show automatically how much you need to accumulate. So let's say you want to accumulate it in 4 years instead of 3. So it will change the calculation. Once you put it in, it will change the calculation. Yeah. So $900 you need to put in every year to accumulate, right? So you would be accumulating 46,850, plus you also get a tax refund, right, which you can invest into this. So overall you'll be able to accumulate down payment. So this is the fantastic reason to start a First Housing Saving Account. So why? First of all, whatever money you're putting in, it is generating interest because you added high interest like cash ETFs into it. And whatever money you put in, so in total you put in $46,000, that money is going to generate tax refunds. So this tax refunds also you can invest back or use it keep it in a different account and accumulate your down payment money. So the investment you're making plus tax refunds plus interest that you're generating all together will aid you towards accumulating down payment. So that's the amazing part about that. Okay. Then another important discussion that you should be having with your partner, right? If you have kids together or if you're a single parent, then it's important to consider it on your own. The plan that you need to work on if you have kids is RESP, Registered Education Savings Plan. So what is this plan? You save money, you put it into an RESP, and the government will do 20% matching by giving you grants. So the rule is whatever money you're putting into an RESP up to $500 per year, they're going to match. So let's say you're putting $2,000. So the government will match 20% of that. So they will give you $400 extra to invest towards your child's education. So that's an amazing thing about RESPs. And you can open an RESP with any broker advisor, or you can also do it on your own by using Wealthsimple. So if you just go to Wealthsimple and search RESPs, it takes it's all online and they will give you all the details, right? So the important part is 20% matching by government. So to max it out, you have to put $2,500 every year per child. So they will give you $500 extra to invest. If you're below income threshold, if your income is very low, they even give you more money. Okay, you can read about it, but this is something that you have to start thinking about. Then you need to also think about your retirement. So why starting early important? Because $100 invested per month from the age of 30 at 8% interest becomes $230,000. But if you delay it by 10 years, if you don't do it in your 30s, if you start at 40s, that will only become $95,000. So there is a huge difference, right, in between when you start. Now, where do you accumulate your retirement funds? You can use tax-free savings account and RRSPs to do that. There are many videos on the channel about tax-free savings account and RRSPs, and also there is a specific video about retirement, so please watch that. And where do you invest? You can either use index funds, stocks, bonds, or mutual funds and REITs to do that. So I'm not going to cover this Google sheet here because there is an extensive video on retirement planning. I will urge you to watch that instead of discussing here. So this was just a guideline. So few things to think about in your 30s. Emergency fund first, down payment for your house, education for your kids, and your retirement. Something to think about and work on. So thank you for attending. All these topics have been covered in more detail. So there is a video about RESP. You can watch that. There is a video about, like, let's say, emergency funds. There is a specific video about retirement planning. You can watch that for more information. Thank you for listening and keep learning.